So the death tax was originally created in 1916. At that stage, it was about 10% was the rate. It is an assessment against every asset that a person has, including life insurance that they own, their personal residence, their retirement plans, any business assets, any savings, any stocks. So if you think about 100% of a person's net worth when they die, it is a tax that is levied against that net worth. It was originally put in place, if you will, when the Rockefellers and a couple of other families owned a significant percentage of the total assets of the country. Even at that stage, it was put in at a rate of 10%. It has gone as high as 70%, and now we have it back down to the 40% level. And we today have an exemption of $14 million. So anything above $14 million, the federal government would get 40% of all that you had that you intended to leave the next generation. So right now, it is any estate worth over $14 million. That is not a significant percentage of the population of the United States. But if you're from small town America like I am, your small town manufacturing company, your farming operations, the people that actually generate the jobs in the communities would in many cases be subject to this federal estate tax. So again, it was designed back in 1916 where it was only going to be assessed against the wealthiest of the wealthy of the country. And again, it was at a rate of 10%. Today, we have a $14 million exemption per person. At the end of this year, that number falls back to 7 million. So right now for 2025, it's anybody who has a net worth above 14 million, and that's all of your assets minus all of your liabilities, including any life insurance benefits you may have. But at the end of the year, that 14 million exemption gets cut in half to 7 million. And so it would obviously bring back in significantly more people. And one of the things that we are asking for in the next piece of tax legislation is permanency on that. If we can keep it at the 14 million, hopefully raise it to 20 or 25 million, but then that number needs to be permanent, whatever that exemption is, so that people can, if we're not able to get the total repeal of it, and I don't expect we will, make plans for the transfer of farms and business assets and other things so that those farms and businesses are allowed to continue into the next generation. The permanency of that number is extremely important, and then hopefully have a reduced rate from the 40%. So an income tax is assessed on an annual basis based on what I earn, right? So I'm going to pay my income tax. I may pay it up to almost the same 40% if I'm a high income earner. And that is the income tax. It's assessed on an annual basis. Capital gains tax is assessed when you sell something and you make a profit on it at 20%. What the difference is, you're paying those taxes on an annual basis. And after you pay the income tax and after you pay the capital gains tax, hopefully you're able to invest and accumulate some wealth. This then is a tax that is assessed on everything you've accumulated after you have paid your income tax, after you have paid capital gains taxes. If you're able to save money and build a business and you've accumulated assets that today are in excess of 14 million, this tax is assessed on everything you've accumulated after you've paid your income tax and your capital gains taxes. And again, that $14 million exemption drops to 7 million at the end of this year. So one of the goals, obviously, is to have that exemption not go below the current 14 million. As a small business owner, you either believe that capital is better off in the hands of the private sector, or you believe that business is better off in the hands of the government. I personally believe that the economy, from the economic standpoint, that our people are better off with capital in the hands of the private sector. And so when you take that capital out of a community and the government has it and then turns around to redistribute it, I do not think that you see the same or any economic growth from that. I think that if you leave the money in the hands of the business owners, the capital in the hands of the people that are growing the jobs in the country, then the economy benefits from that, and you have economic growth, and everybody benefits from that. It's an inconsequential amount of revenue to the federal government. If you look at our overall tax revenues, it's less than 1% of the total tax revenues of the federal government. But again, if you represent communities like I do, I live in Tifton, Georgia. You know, if your local medium to large business owner dies and you pull that much capital out of the community, it has a devastating impact on the jobs and the economic growth of the community. So ultimately, I think you actually have higher tax revenues not having the federal estate tax by leaving the capital in the private sector than you have by having the federal estate tax. And now let's be clear about something. Most of your supersized estates in the country set up foundations anyway that they put the money into. And obviously, if they put the money into a foundation, they don't pay federal estate taxes on what goes into the foundation. And truth be told, they don't pay income or capital gains tax in most cases on what they have in those foundations. So there is the discussion about the total repeal of it. I personally am fine with the total repeal of it. I do not think that we will get the votes for the total repeal passed through the House or the Senate. We've tried this before. We haven't been able to get the total repeal of it done. And so what I do think is possible, hopefully probable, is that you take the $14 million exemption. Hopefully we're able to increase it. Hopefully we're able to add an inflation factor so that it continues to go up every year. But we don't have this reversion in the assessment as we have between 25 and 26. It is impossible for a business owner to plan if the exemption is 14 million one year, 7 million the next. So we need to get some permanency in an exemption that is high enough, hopefully in the $20+ million range, with an inflation adjustment to it, that our mid-size business owners and farmers can make plans for the efficient transfer of assets so that we're able to keep those jobs and those assets in the community. That is what I would hope that we get to. I also hope that we can get rid of this 40% tax bracket on it and hopefully pull that bracket down to somewhere in the 20% range. So a permanent exemption of $20 million with an inflation adjustment and a rate that's closer to 20% instead of 40%. That's something that I think most of us who want to see the capital remain in the hands of the private sector would consider a win.